LECHA facilitates African capital for investment in African projects. There is over $1 trillion in capital waiting to be deployed in Africa for African governments and state-owned enterprises to finance infrastructure projects. African pension funds, family offices, and sovereign wealth funds have entrusted these funds to asset managers abroad. A significant portion of these funds is offshore. What is unfortunate is, African governments raise loans from these funds at a significantly higher cost of capital than if they had borrowed locally, because of the Africa risk premium. These African funds are developing Western economies, while Africa decries a lack of funding or unsustainable interest on dollar and euro-denominated loans. African governments are trying to attract foreign direct investment, while African financial institutions have the capital to finance local projects at a lower cost of capital. African economies need to develop deeper financial markets with more sophisticated financial instruments to attract local capital. South Africa, Morocco, Ghana, Egypt, and Nigeria have made significant progress in this regard. These advanced markets need to provide a platform for the rest of the African countries to float pan-African treasury bills and bonds, municipal and sub-sovereign bonds. Other instruments that we need to develop across African financial markets include Afrobonds, syndicated loans and thematic bonds, green, social, sustainability, and SOEs bonds. These will be targeted at renewable energy projects, food production, health, and education. Governments can negotiate funding with sustainable repayment terms on multilateral and bilateral finance from institutions such as the World Bank, African Development Bank, Islamic Development Bank, Agence Française de Développement, Kreditanstalt für Wiederaufbau, or China Exim, and similar development finance institutions. Due to the limited resources and the serious deficit in infrastructure development, African countries have public-private partnerships, concessions and infrastructure project finance as another option to consider. Climate and blended finance, sovereign wealth funds and diaspora bonds are yet another sustainable alternative to finance African infrastructure projects. LECHA believes the real challenge is matching the right instrument to the right need, and then getting the fundamentals in order: accounts, governance, permits, ESG. African countries that rank high in these dimensions. Countries internationally rated as investable grade, such as Botswana, should not struggle to raise capital from African financial markets. However, they do. Structuring risk properly, this relates to currency, tenor, security, and guarantees. African fund managers intimately understand the risks inherent in African financial markets. Most importantly, African governments need to present projects in a way that investors recognize as bankable. Africa is not short of capital. It is short of well-prepared, well-structured deals. Africa is short of African financial markets that believe in African governments and their capability and capacity to deliver world-class projects within budget and on time. LECHA believes that Africa must attain financial sovereignty. Africa must finance African projects internally. A sovereign Africa is an industrialized Africa that processes all of its minerals and commodities in Africa and exports finished goods. LECHA facilitates the sourcing and structuring of infrastructure development finance. LECHA, so much better.